everyone, and welcome to the Final Bar. It's Tuesday, July 2nd. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close today as the S&P closes above 5,500 for the first time ever. Seems like we're seeing that strength in July that the seasonality would suggest, because July has been one of the strongest months of the 12, going back to the 2009 market low. So with seasonal strength and with prices heading higher, let's go to our market recap and see how the charts played out through the course of the day today. Looking at the market dashboard here on Stockcharts.com, we can see that the S&P 500 finished above 5,500 for the first time ever, closing at 5,509. That's up 0.6% from Monday's close. The NASDAQ composite even stronger, up 0.8%. And the mid and small cap S&P indexes up as well. The VIX continuing to push a little bit lower, not quite getting down to an 11 handle, just sitting right above 12. But VIX in the low teens, of course, means low volatility, low uncertainty, low fear. That is a bullish reading. One of those warning signs we've been talking about here as we go into July and begin third quarter of 2024 is a spike in volatility. And while that doesn't guarantee that the market's going lower, given the fact that we've had an extended rally, a protracted incline with low volatility, a spike in volatility usually means that rally phase is most likely ending. So not today. We're seeing volatility remain fairly low. Looking at interest rates, kind of a choppy session you can see here with the 10-year yield sort of chopping around that 440 level, finishing the day around 444. The long bond yield just about 4.6%. The 5-year point similar to the 10-year point, around 4.4%. The yield curve still remains inverted with the short end of the curve, which is where the Fed really controls things, remaining well above 5%. And so we have that inverted yield curve, which has been a pretty decent predictor of recessionary periods. It does not feel like a recession if you look at market performance, because the equity markets are rallying pretty significantly. But it really speaks to the economic data underlying the equity markets. The Fed, of course, expectations all about when will be the timing of their that first rate cut and how many rate cuts we may see this year. Now it's looking like one is an optimistic outlook for 2024. But certainly the economic data coming further lower and lower. Any new economic data we get. So, for example, this Friday we've got the latest reading, making sure that it continues to demonstrate the economy slowing down in reaction to rates that remain fairly high, according to the Fed's work. The dollar index slightly lower from yesterday's close, no real change there. So, the other warning sign we talked about was a spike in the dollar. You're not really seeing that just yet. Commodities overall, a little bit mixed, to be honest with you. The DBC, which is a broad commodity ETF, finished not too far from where we finished the trading day on Monday. Gold prices almost unchanged from yesterday. Silver prices and copper slightly higher. Crude oil slightly lower. Overall commodities, kind of treading water, I would say, on that medium-term time frame. Cryptocurrencies continue to be fairly volatile. Bitcoin is currently trading just below 62,000. That's down about 1.4%. Ether price is holding steady just above 3,400. You can see that it's sort of mixed results here for cryptocurrencies. Let's go to the 11 S&P sectors. Tesla having another pretty solid day. That's your top performer, up about 10% today. Well, I didn't get a chance to look right after the close, but we'll see where things played out. But the XLY, driven by Tesla, Amazon, those type of stocks having a pretty decent week. Up almost 2% to lead the way higher. Financial sector number 2 at a positive 1.2%. Communication services number 3 up 0.9%. Only 2 of the 11 S&P sectors were down. Healthcare down about 1/3%. Energy essentially flat from the day, and materials just slightly higher from yesterday's close. Our market trend model here, again, still updated intra-week, but really isn't formally updated until Friday's close. As of Friday's close, the mid-cap model was bearish on the short term. Everything else is fairly constructive here. Now, here we're looking at the what I call the Magnificent Seven and Friends, these 8 leading growth stocks. You can see Microsoft is the worst performer of the group, and it's still up 0.6%. Netflix slightly higher than that. Tesla, the real story there, up another 10%. today. They reported most recent orders came in higher than expected, and so Tesla having a real nice run of things here over the last couple weeks. Nice rotation higher after lagging behind the rest of the mega cap growth trade for some time. You can see Tesla having a nice update as well. Apple also up over 1.5%. Let's go to a daily chart of the S&P 500, see how things played out. And what's so funny is after all of those things that I just mentioned, including the S&P making a new all-time closing high, we're still arguably very much range bound. We did close above 5,500, which is getting us, potentially out of this consolidation phase. But over the last 2 weeks, we've been essentially in a little tight range between 5,450 and 5,500. And ranges happen quite often when you look at charts of stocks and ETFs. And I think in a lot of ways, they provide a very easy idea, because what you look for is once that range is firmly established, once we have that consolidation range, look to see when we are able to break out to the upside and or break out to the downside. And that often tells you, once we've had this consolidation, the next big move can be a sign of new momentum to the upside or the downside. It certainly appears that here to start off Q3, that is, we're seeing potential rotation to the upside. Now, after we've closed outside of this range above 5,500, it's all about follow through. Tomorrow, we've got the shortened trading day for the 4th of July holiday. So usually the playbook in a shortened holiday week is lighter volume and flat to positive, usually a little more high, drifting higher is kind of the general, playbook you would expect. And then next week is when we get back to a normal trading week. We start to get into the meat of our earnings season, and we'll have a lot of potential catalysts to talk about. But for now, nice move to the upside. The S&P once again overbought. We spent most of the last couple weeks in the overbought range with an RSI above 70. Today's bounce is pushing us just slightly above there. You know, what's so interesting, though, is as you're looking at the S&P making a new closing high, the question is, what's moving the markets up there, right? I mean, even today, as we're processing the closing data here within the S&P 500, 17 out of the 500 stocks made a new 52-week high today. So that's through 8.5% of the S&P. That's pretty small, right? That's actually not true. That's 3.5% of the S&P, right? 3.4% of the S&P making a new 52-week high today. So while the S&P is making a new 52-week closing high, most stocks are not doing so. And I think that is a very telling phenomenon here. If you look at the last couple weeks, we've seen the S&P holding steady in that range, but not a ton of new stocks driving higher. And I think the S&P exiting from this range and pushing up, the bullish outcome, I think the bullish, tell for July would be an expansion in new 52-week highs. You really need, I would argue, more than Meta and Alphabet making new 52-week highs to really propel this market to sustainable gains above what we've seen so far, and more meaningful gains, I guess, than we've seen thus far. We haven't seen it yet. Overall, the S&P sort of attempting to push out of this range, but not a lot of stocks actually driving. You need those leading names, and I would argue that the breadth conditions, you probably want to see those improve quite a bit more than we have so far. To sort of put another bullet point on that, questionable outlook of meager breadth readings, look at this one. This is the percent of stocks above their 200-day moving average and above their 50-day moving average. Let's look at each one of these together. Now, first, look at the first quarter of 2024, January, February, March. Look what these indicators were doing in March of this year, right? Over time, you had more and more stocks getting above their 200-day moving average. At the end of Q1, it's about 85% of the S&P members above their 200-day. That's about right for a bull market phase. About 85% above their 50-day moving average. That's pretty good as well for a bull market phase. Now, you look at the end of June, we're making another new all-time high, but only 67% of the S&P members are above their 200-day. That's down from 85%. It's about 20% of the S&P 500 members were above their 200-day at the end of the first quarter, and now are not above their 200-day as the S&P has gone up from 5,250 to 5,500, right? So we've gained all of that, but less stocks are part of it. Here we see 85% of stocks above their 50-day at the end of March. Here at the end of June, it's around 45%, right? So about 40% of the S&P stocks were above their 50-day moving average here. and are not above their 50-day moving average here. So while the S&P has gone higher, this sort of chart reminds you that it's not a broad advance, right? There are less and less stocks that are actually looking like the S&P. In a healthy bull market phase, a lot of stocks should kind of look like the chart of the S&P 500 because they're all kind of working. Now you're not really seeing that. You're seeing a lot of stocks look very different than the chart of the S&P and the NASDAQ. And while indexes obviously can go higher, driven by those mega cap growth names, I would argue that it speaks to limited upside beyond these levels, because the problem is you're not really seeing those opportunities underneath the hood. And if you own stocks outside of the Magnificent Seven, you're probably not doing particularly well on a relative basis, which means that's a super crowded trade. Everyone has to be there. And when that trade unwinds is often when a major top can play out. So we'll see if that actually happens here. Not happening yet. I did want to mention, because we've had some questions coming to the mailbag and elsewhere about the Hindenburg Omen. As I'm sure you can guess, I will make some noise when the Hindenburg Omen would signal a second time. We're not really seeing that yet. And as a reminder, the Hindenburg Omen is a combination of three different components, three different factors. And the question is, when are they in agreement, right? When do they all signal? The three factors are as such. Number one, you have to have the New York Composite Index in a primary uptrend, which it is. The rate of change for the last 50 days is above zero. You need to have the McClellan oscillator that rotates below zero. We actually have just seen that a couple times here just in the last week. But the third component that has not triggered yet is on the same day, you need at least 2.5% of the NYSE listings making a new 52-week high, and at least 2.5% making a new 52-week low. The key to this particular combination of bearish signals that often happen at a market top is that you have a dramatic number of new highs and new lows during a particular period. And that indecision that is represented by these stocks making new highs and new lows at the same time is what really triggers the Hindenburg Omen. So now it has been over a month since the previous Hindenburg Omen signal, which would mean if we would get another one this week, you'd have to wait to get another confirmation over the next 30 days or so. The cluster of the Hindenburg Omen signals is what we're really looking for. You can see the last couple times that that's happened has indeed been most likely a meaningful top. We're not getting that now, and there's been enough time since that previous signal at the end of May. Now that we're going into July, the whole thing would have to reset. So we'll keep an eye on the space, see if there's another sign, which again has been a pretty classic sell signal when you get all of those to agree. Not happening just yet, and it's the lack of stocks making new highs and new lows. That's the real story here. Most stocks are not in either of those buckets. All right, to finish off today, let's look at some individual stocks. We'll go with Tesla to start out with. I mean, just an impressive run higher, right? And I think what's interesting about the chart of Tesla is you can draw a series of trend lines from previous tops. And depending on how you want to draw these, we might want to draw that one, which certainly looked like the key trend line in the fourth quarter. We briefly broke above it and failed, and now we're all of a sudden breaking above it as well. I may want to draw the trend line maybe using these peaks, in which case we're kind of right there. I don't know if I feel great about that because that's really only connecting 2 points here. But for what it's worth, we're sort of right at that level. But then you also have these other what we call secondary trend lines here, where you take secondary levels that are broken. My point is, however you're drawing trend lines, most likely Tesla is breaking out here this week because of the acceleration. So the question is, what do you do now? And I would say what makes sense to me is become a trend follower, right? And when you see something starting to work, start to draw trend lines using the previous swing lows, because as the trend accelerates, we can use those trend lines as a way of managing risk. Now, there are more sophisticated ways to do this, using something like the chandelier exit system or average true range or something like that, or even technical levels like moving averages. But using trend lines, particularly when something's really started to accelerate, it can just help you quantify that uptrend and recognize when the trend has shifted. So number one, I would say we have broken trend line resistance, and I'd probably use this one. Consider this a failed break. Let me get rid of the noise here. So I'd probably not consider this one the primary trend. I'd probably use this one because it connected a number of levels. We had a failed breakout. We then had a valid breakout over the last week, and now we've accelerated to the upside. We're now above the 200-day moving average for the first time since early January. That's impressive. The RSI finished the day today over 80. We would always call that good overbought, and I'll show you an example of that back here in June of last year. Look how we became overbought. Then the RSI went above 80. And what that usually means is even if you get a pullback out of the overbought conditions, you probably get at least one more leg higher because the momentum is so strong. You probably have at least enough in the tank for another move higher. That often comes with weaker RSI on the new highs. And that can be your major market tops. The fact that we've had an RSI above 80 now suggests that we may get a brief pullback. That's reasonable given the run that we've had. But the momentum is so strong, you probably want to treat that as an opportunity to ride the next leg higher. And that's kind of what we're seeing with the chart of Tesla here. Had some questions recently about Visa and Mastercard, and thanks. One of you put a question in the comment section below one of our shows earlier this week or last week. I forget where it was, but appreciate that question. Visa and Mastercard both in actually a very similar sort of move here. And when you look at these charts, you see the run higher. You see the rotation below the 50-day moving average, which is now sloping downwards. Look at how Mastercard now riding that declining 50-day lower. You can see that the RSI has gone from being in a very bullish range, mostly above 50, to now a very bearish range, mostly below 50. You can see how the relative strength has deteriorated in Q2 after holding in there in Q1, What I would look for with the chart of Mastercard, a couple of things. Number one, we are bouncing off the 200-day moving average. Today, a bullish engulfing pattern as we test support. I love when we test a long-term support level and we have a bullish short-term pattern that happens as we test support. That often, to me, further validates the importance of that support level and the fact that we most likely are going to find that support and bounce higher. This says the next 1 to 3 bars, most likely higher rather than lower. Now, a break below today's low and or also the 200-day moving average would invalidate that signal and tell you more downside potential. But for now, I like the setup. Testing a previous support, giving a bullish engulfing pattern at a 200-day moving average certainly seems like a nice opportunity to ride this move back higher. Resistance overhead around 460, so we're sort of in a bit of a consolidation range. But if this can get above 450, the 50-day, and 460, make a new swing high, boy, that could be a nice run higher. But I like potentially a mean reversion bounce off of support here. By the way, as we talk about candle patterns, did want to let you know we're talking with Steve Nissen, who literally is credited with bringing candlestick analysis from Japan to Western investors, and he wrote a number of books that are widely regarded that sort of defined candle patterns for a whole generation of investors, me included. I'm going to be sitting down virtually with Steve Nissen. That'll be a couple weeks out, but we're sort of getting things lined up here. We've talked about having some guests come through the final bar. He will be our first one in this new version of our show, and thanks for your patience as we get all of that. But look, all that straightened out. But look for that announcement here very, very soon. CF is another one, and this is one of the worst performers here, down about 3.5%, which is pretty rough. But what I wanted to illustrate on this chart is the fact that we've had a bit of a rotation to now more of a distribution phase. Now, what marks a distribution phase? In my vernacular, it's a pattern of lower highs and lower lows. Usually means we're below 2 downward sloping moving averages, means the RSI is consistently below 60, and particularly when you have rallies within this phase, the RSI usually fails to get much above 60, and you have declining relative strength. I think CF right about here is a great example of a chart in a distribution mode, right? The new lows undercutting support at 72.50. Look at how often that has been a support level. It's now broken. The momentum remains quite weak. The relative strength is weak. We're below 2 downward sloping moving averages. I'm happy when all of those things change, and that would be a rotation to an accumulation phase. For now, charts like this, I think, are guilty until proven innocent. Healthcare has been a particularly rough place to be, but I do want to highlight AbbVie rotating lower today, down about 2.5%. It's after having a nice bounce off of the 200-day moving average here in mid-June. We got up to around $173 a share. It certainly looked like we could be returning back up to that 180 level, but today we're actually rotating lower. I want to highlight what I'd probably call a pivot point, which is basically the horizontal line that I'm indicating here. Look how many times the price touches that point. from above and from below. There's a gap here in mid-April right around this point. This is around $165 a share. We've pulled back to that level of support. Again, the 50-day moving average is right around there as well. For me, that means a break below 165 opens the door to a retest of the 200-day moving average, maybe even a retest of the May lows, but it certainly tells me that the strength that we observed in the first part of June is not materializing. It's kind of evaporated. Buyers are nowhere to be found. And all of a sudden, we're rotating back lower. See if we can put in a higher low. That could be a good opportunity maybe to re-enter a stock like AbbVie. But overall, taking a step back, this is a period of weakness. And today really not helping the bull case. We'll finish off with DPZ. Domino's Pizza Group, and again, another illustration of a stock, I think, rotating into more of a distribution phase. Look at the new high in late March of this year, as we made a new 52-week high, closed above $500 for the first time, the RSI over 80. As we mentioned before, that often is a good overbought, meaning we're probably going to get at least another leg higher, which we did. In the end of April, we got up to around $540 a share. The RSI did become overbought, but nowhere near the RSIs before, so we have a bearish momentum divergence. Now, we retest that level in mid-June. We don't get above 540, and the RSI stalls out right around 60. So while we have sold off this week, while we're now below the 50-day moving average and below the May swing low, I think we've seen a lot of the signs of rotation before this week with the lower high, with the weaker momentum, with the declining relative strength. Now we see Domino's below 500. Until it gets back above 500, I'm inclined to be patient and wait on a chart like DPZ. Folks, that's our show for today. Thanks for joining us every weekday after the close for the final bar. We'll have an adjusted programming schedule this week. No show on Thursday and Friday because of the 4th of July holiday, but we'll be here after the close tomorrow on Wednesday with a recap of what happened going into the holiday weekend. Be well, stay safe, have a good night.